Let's examine the accounting for the sale of receivables, or sometimes referred to as transfers of receivables. We always begin our discussion with a discussion of the underlying economic substance related to these transactions. Now, in many cases, companies can accelerate the receipt of cash for their accounts receivable by transferring them to a third party. These are referred to as factors in many cases. A factor is either a bank or finance company that's in the business of lending money to companies. In this case, they're lending money to the holder of the receivables so they can receive cash quicker with respect to those accounts receivable. The accounting issue with respect to these transfers is whether the transfer should be treated as a sale or as a borrowing. Under a borrowing arrangement, the receivables are pledged as collateral, and the owner of the receivables has a loan obligation related to that. So they record cash and an offsetting liability for the amount of that obligation. In a sale treatment, the seller receives cash and the transferred receivables are derecognized. That means they're taken off the books. And a loss is recorded related to that sale, which is essentially a finance charge related to that transfer to the factor financial institution. Now, there are two types. We need to be careful in order to get sale treatment to meet certain criteria, and there are three of them. First, the receivable must be isolated from the selling company. Usually by transferring, that happens. Secondly, the purchaser has to have total control over the receivables. That means they can sell or pledge or do anything they like with the receivables once they are transferred to them. And then finally, the seller cannot have any control over the receivables. That is, they cannot have the possibility of having to take the receivables back. Now, there are two common selling situations. The first is a sale with recourse. And the sale with recourse, the seller bears the risk of uncollectible accounts. So in that case, if one of the accounts transferred to the factor ends up being uncollectible, the seller has to make good on that to the factor. The second situation is the sale without recourse. In that case, the seller is completely resolved of any relationship with the receivables, and in that case, the factor bears the risk of uncollectible accounts. Now, let's take a look at an exercise to illustrate these concepts with respect to the sale of receivables. To illustrate the accounting for transfer of receivables, let's take a look at the transfer from Gringo Corporation to Winkler Financing. Gringo has factored or transferred $250,800 of its accounts receivable to Winkler on a recourse basis. That's important, as we'll see when we do the entries in just a minute. The receivables are transferred to Winkler on August 15th, 2012, and Winkler assesses a finance charge of 2% and reserves 4% for adjustments related to returns and allowances. So, assuming the conditions of a sale are met, we want to prepare the journal entry for Gringo to record the sale of the receivables. So the best way to analyze this is to build the journal entry related to this transfer. So let's see what's going to happen. Well, first, as we discussed, Gringo will receive cash and it will transfer its accounts receivable. So that'll be a credit to transfer the accounts receivable. Secondly, we know there's a due from factor. That's for those returns and allowances. That's a debit. There's a recourse liability because Gringo has promised to make good on any bad debts in the receivables that have been transferred. Right? And then the final piece of this journal entry will be the loss on the sale. So what we need to do now is to fill in this journal entry, and the final entry will be the loss on the sale. So let's first record accounts receivable credit, and that's $255,800. Right? And we don't usually put dollar signs in there. Then let's figure out the proceeds. So first of all, Gringo will get $240,452, and that's the receivables, 800 times 94%, right? Because Winkler is going to hold back the 2% and the 4%, okay? The due from factor is an additional asset, and that's 10,232, right? Again, that's, again, 4% of the 255,800. And so the net proceeds to Winkler is 250,684. Okay, so that's our net proceeds. Now we can fill in some more of the journal entry, right? The cash is the 240,452, right? And the recourse liability is 3,320. Right? So now all we need to do is take this net proceeds, deduct the recourse liability. That gives us 247,364. Okay, now the due from factor we computed is 10,232. And so now all we need to do is determine the loss, and that's 255,800, right? Deducted from this 247,364, the loss is 8,436. And now our journal entry balances. So Winkler has transferred the accounts receivable, recorded a liability for the recourse obligation, and recorded these two assets. He received cash and due from factor. The difference is the loss of 8436 on the transfer of those receivables. To summarize the accounting for transfer of receivables, remember that companies can accelerate collection of their accounts receivables by transferring them to a third party like a factor. In order to get sale treatment, they need to meet those three criteria: transferring the receivables, the purchaser having control of the receivables, and then no requirement to take the receivables back. Once you meet sale treatment, then we account for the assets and liabilities that arise from that transfer of the receivables, including a possible recourse liability for receivables transferred with recourse. Now note, incorrect application of these GAAP provisions were at the root of the financial crisis, in that many companies entered into loans with questionable features where they had to take back loans that were transferred under these GAAP provisions.